Hey traders, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 16, 2024. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on that docket today? We've got a lot of stuff working today, so pay attention. Get out your sticky notes. The market has been approaching, is still short of the trend line that we've been discussing. As a refresher, we can go over to the monthly chart is the easiest thing to do. And we say we have a high from the high in 2007. We've already used this one. I took it off the chart. And it connects to a high in January of 22. And that's where we are now. So from a monthly chart perspective, looks like we almost hit it. But when you go to a daily chart, not quite yet. She's about $1 or so higher from today's high. Now, we have an on-time type of situation tomorrow. Some traders in the live room had been discussing about an on-time situation yesterday into today, and that is a truism. However, there's an on-time situation tomorrow at the trend line tomorrow. And I'm going to tell you the same thing I told the traders in the live trading room this morning before the market opens. If they hit the trend line, I'm going to short the tape, and here's how I'm going to do it, meaning I'm going to go short the SPY. I'm going to use put options. I'm going to give myself 2 weeks to expiration, and I'm going to sit on it because we have number one, waning velocity. What does that mean? As the market rises or as the market falls, it can only go so far without the rubber band being stretched so far that it's got to snap back a little. We talk about that when the market's falling. We say they're going to find some number and the market's going to snap back. You're going to get a little bit of a squeeze operation, some pies in the face, all that stuff. And the same thing applies up above. The rubber band is getting stretched. They're going to find resistance. They're going to pull back and have a corrective move. The first logical place they would come to from a big picture perspective is where? How about 524.61? Why is that? Because that was the place where they ran up to, couldn't get any higher, had a rejection, a reasonable corrective move, and then the market went right back up and it blew through that area. That is the most recent breakout area on the tape. There may be some, and there are some numbers from an intraday perspective above that, but from a swing trading perspective, if I'm shorting the trend line for argument's sake, then my exit, first exit, not necessarily final exit, is going to be at 524, a little bit above 61. Not going to wait for him to get all the way to the number. You want to sell into strength. You want to buy into weakness. You don't want to chase the market around. You want to cover a short trade into a rising market, into the strength of the market at a resistance or right in front of a resistance place. Same thing on the way back down. You want to sell into a declining market at an important place, right in front of an important place. Why? Those important places are magnetic. We've seen this many, many times before. While I can't tell you when they're going to revisit 524.61, I can tell you they will revisit 524.61 sooner than later. Put that in your pipe and smoke it. If they go up tomorrow on Friday, hanging around the trend line, stay there into the weekend, into next week, it's still a resistance area. They can play with it for a while, but as I showed you last night with the other trend line, it took them almost 3 full trading weeks to really get through the former trend line. They had several pullbacks away from the trend line before busting through. This would constitute one of them. I'm looking for the market to go and reach the trend line. It's not a guarantee it will, but this is the what if scenario. What if they're up there tomorrow? And that's my story, and I'm sticking to it. Nothing new to see here on the weekly chart, same routine. The only thing you have on the board at new highs is the trend line. What if they close the week below 524.61 tomorrow, Friday's close? Well, that is the makings of, it's the beginning, ing in italics, beginning of a breakout failure situation or failed breakout situation. Not much to discuss from an inside the number perspective. The only thing we had at new highs was the trend line area, and you can see that throughout the morning session that the market was really dull. It was like watching paint dry. Then it was like a turtle watching paint dry, or watching a turtle watch paint dry. Sometimes it's not a trader's tape. Really hasn't been much of a trader's tape all week long. Been a one-way ticket minus a little pullback this afternoon. That's about it. Pause the video, read the notes, go back to the chart, and double check the work. But we have to take the market that is, not the one we want it to be. We cannot, and this is a trader-ism, one to be put on a sticky note, we cannot impose our will on the market. We did have two stocks on the move today. Deere, DE, did not hit its entry objective, therefore it's off the board. It's a no trade. However, EDU did, so let's take a look at that chart. We'll start with the numbers work. EDU getting a haircut at the opening bell. 82.10 was the number. Came into it, spiked it at a rocket right away, gave you $2 pretty quickly and then some. Came all the way back down to run a test of the exact same number. That reinforces the concept that the numbers work, and then bounced off of it into the end of the day. The trade was in here. We had plenty of participation in the live room. Traders made money on EDU. Of course, numbers provided before the opening bell. Funny how that works. You have to wonder sometimes, how does that work? Here's another little trade we had in the live room today. 26.88 an upstart. Hit it, bounced off of it, gave us the base hit and then some, gave us roughly 38.39 cents, which is well above the minimum required base hit. It's a low price stock, so you're not looking for a $4 pop. 1% is basically 26.27 cents. Base hits put you in the Hall of Fame. This was a real-time, stock is moving after the opening bell, live room situation. What's going on over in Camp IWM, my favorite market-leading indicator? Well, guess what? Relative weakness today. Is that an indication? Is that a hint, a clue of things to come? It can be. Below yesterday's low, opens the door to fill the gap from the day before, and then all of a sudden, you have this 210 area that is unfinished business. Not being able to get to 210 is a problem for the IWM. Will they do it on Friday? We don't know. Will they gap down on Friday? We don't know. But there's a hint of weakness if they can't get to 210 after coming up short. They made a choice not to get there. There are no accidents, no coincidences. From a weekly chart perspective, what did they do this week? They ran a test just like they did last week in the vicinity of the breakdown candle high. So last week, we're looking at this candle they ran a test of, and you can see this tail candle, they ran a test, and they pulled back. First time, best time. Now, this week, they ran a test of the next breakdown candle high. They didn't quite get to the high. They didn't get to 210. However, they got in the vicinity of, from a weekly chart conceptual perspective, they got in the vicinity of, they're running a test or have run a test of a weekly chart breakdown candle high, first time, best time, unlikely to blow through those places, especially on the first time up there. When you look at the monthly chart, and this applies to all charts, but this happens to show up on a monthly chart, so I want to show you this. You have a reversal candle last month. This month, you have a potential reversal of the reversal. So if you reverse last month's candle and close above it in the month of May, that's a very bullish sign under normal garden variety conditions. However, if they run a test of the top and by the end of May, they're closing halfway down or even somewhere in the low area of last month's candle, well, then you know that's a different story altogether. From a monthly chart perspective, we gauge it week by week. From a weekly chart perspective, we gauge it day by day. From an intraday perspective, we gauge it with the intraday charts. And we take all of them into account in our major analysis starting the day. Maybe some light bulbs just flickered on a little bit. What about the folks down at the transportation department? Didn't really have much relative weakness. Had some early in the day, but they snapped back to finish close to the flat line. So they were basically on par with the S&P. Can't really make heads or tails out of a close down 20 points on a $15,000, $16,000 index. So they closed pretty much just below where they closed yesterday. We'll just leave it alone and say they've spiked into these moving averages. They can't yet get through. We don't know whether they're going to eat some time off the clock or come back toward this 200 period moving average on the daily chart. Weekly chart perspective, they spiked into the 20-week moving average this week. They're finding overhead resistance in that neighborhood. You see how the story just changes a little bit? You get a bigger picture perspective, a smaller picture perspective, and you look at different things. The concept when I bring up the weekly chart is, simple thing. They just tested the 20-week moving average, and if they close above it this week from a weekly chart perspective, I'm going to take that as on the bullish side. If they don't close above it, they've tested the 20-week moving average, and we move on to other charts and next week. What about the Q people? A little bit of a tail candle like the spiders today, but it's a very small tail. It's not a reversal candle. It's not a sign or signal of a trend change just yet. You didn't have accompanying volume. So we just need to know all that stuff. I didn't discuss it on the spiders, but when you look at the spiders, you have the same routine. You don't have increasing volume. You don't have a big tail. This is just a pop higher and a finish near the lows on a very narrow ranging day. So the market didn't really give us a whole lot of information today with an expansive range. It was a narrow ranging day. It was a dud of a market. We're not going to totally discount finishing on the lows. Finishing on the lows of the day is never a good signal. It doesn't necessarily mean tomorrow's bearish, but it's never a good signal, especially when they tried to rally it before the close and then the last 5-minute candle gave up the ghost and finished on the lows. So we had a failed attempted rescue operation from 350 to 355. Failure occurred. Should we read into that too much? Not necessarily. Qs, new highs, same routine. At new highs, we're looking for a sign or signal of a trend change. In the spiders, I'm looking for the trend line. What do we have in terms of the Qs? 449.34. What does that represent? The former highs that they ran up to before selling off. That constitute a former breakout area, and therefore, regardless of wherever the Qs find overhead resistance, they will pay another visit back down to 449.34. Same routine as the spiders. All charts act and react the same way. No difference in the XLF. They poked their head up above a new high. Little tiny tail candle. Nothing wrong with this tape. They did not close at a new high, but they just poked their head above, closed at the lows again. And again, that may be meaningful leading into tomorrow, but we won't know until tomorrow. It can't be good information for the market, all these markets finishing at the lows, but it doesn't necessarily have to be directly immediate bearish information. Might have different meaning if the market was down all day, if it was a big sell day. That may have a different meaning. That may mean something that we may want to take action on potentially as traders. However, this narrow ranging day today precludes any of this stuff from really having big time meaning. Little bit of relative weakness for Smashmouth, the Philadelphia Semiconductor Index, down $1.70, about 0.7%. Again, finishing at the lows, pretty good proxy for the tech space as a whole. Market's overextended. We have waning velocity, all that stuff. So we will have a correction. So are these clues? Are they clues leading into tomorrow? The correction that I'm suggesting isn't necessarily for half a day or a day, but they're going to correct the market to an extent that retraces a portion of the move. Well, let's look at the SMH just as an example. So let's say this is a high. We're using it as a hypothetical. Today's high is a high. You take the recent standout low and just let's say a third of the correction or a third of the rally, a 382 retracement roughly, is all the way down here at 220. Even a 25% is down 226, 225. So there's a long way to go to have a reasonable correction that can still keep the market in a bullish stance. Have I told you how much I appreciate each and every one of you? Without you, These videos, they're not possible. That is true and accurate information. We're pulling the ripcord here today. I'm David Frost, My Strategic Forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.